When I got laid off during COVID, I was like, I'm gonna learn options and decided to just work through it every day. I think a lot of people can relate to this, but it's like I was doing everything right. Like I went to school, I got a good degree, I worked a lot of hours, I like did the 1980s company man thing. And options was like the one thing where it's like you could make a huge return on this and there's not really any bullshit about why that happens. I've traded 1,000 straight trading days and I make roughly 200 trades a day. That type of repetition, I went through like individual stocks, looking at charts, using discretion, only trading one time of the day, to basically now doing what I call dragnet theory. People just struggle with it, especially males. But basically, like when males take risk, they bring up testosterone to prepare for that risk. Then when they take that risk, if they succeed, that further proliferates the testosterone feedback loop, which makes them take more risk and be less risk averse. And this eventually goes until it all rolls over. And it's the story of essentially every bull market. Only 20% of all hours in the week are during market trading hours. Like you can tell that's pretty damn uncorrelated to anything you're trading. And then on top of that, we're trading options every 2 minutes on the index.
Welcome back to the Unpacking the Markets podcast. Now, before we kick off, can I please ask you to subscribe to this channel so that we can continue to grow and help traders worldwide? Let's get into it. From construction worker to hedge fund manager, and I'm pretty sure it's in quite a short period of time. So can you talk a little bit about how that happened?
Yeah. I mean, I was never really a good employee, I guess I would say. So, when I was in university in 2013, 2014, whatever, when we were choosing majors, it's like it was still a very safe pick to choose engineering. So I chose construction. It's like you make good salary, you'll do good. And then, the Trump asset boom really started to happen. And the '08 quantitative easing thing of return on capital, like 10x is the return on skilled labor. So I was pretty frustrated in the Bay Area. I worked, 60 hours a week, worked up fast in my construction career. I was also on the engineering side. Like I was a superintendent, so I wasn't swinging a hammer or anything. And I was doing stem cell manufacturing labs and critical infrastructure and occupied hospitals. So I wasn't playing brick or anything. And then as that happened, I, was like, I'm going to do real estate. I was listening to a podcast on the way home from work, commuting several hours a day, knew it would never pan out. I looked around me and was like, I don't want any of these people's lives who are my bosses. Bought some real estate quadplexes in Austin, Texas. And I was basically on the wrong side of 2020. I was building skyscrapers. My job was irrelevant. Everyone else boomed off the asset boom. And the day I got laid off, I was like, oh, I'm going to learn how to trade options. My dad had always traded options. I'm familiar with that. And then I basically went back to work and decided I was not going to work. I was the worst employee and all I did was trade options to a T. And probably the only reason I was able to stay employed is because, the construction industry is a very conservative based group of people. And I was like one of the few vaccinated people in my company, and they needed vaccinated people to work in these occupied biotech labs, obviously in San Francisco. So I basically was getting paid to trade options because I had the COVID vaccine. And I basically did that until one day where an old guy had retired because he was too swamped with work, and I had taken over his job or whatever, and they thought it was going to be like a big career jump for me. And I basically told them I'm going to get my refi out of my house and, quit construction. And I ended up screwing up and getting fired. But throughout that whole period, I didn't get my refi out. I'd been studying options more and more. And when they went 3 days to 5 days a week in zero-DTE, I'd really realized there was a lot of edge in it. And I was like, whatever, I'm going to dedicate my life to doing this, and basically did it for a pretty absorbent amount of hours, met people online, found stuff. And then I went to a lot of Tony Robbins conference, kind of drank the Kool-Aid, and I was like, I'm going to do this. And then I opened up a hedge fund, and I like to call it the unplanned pregnancy method, where whatever you do, you can figure out in 9 months. Like if God gives you 9 months to figure out how to have a kid, you can open a business with any of that. So yeah, I started the hedge fund by the seat of my pants. If you don't know this, I basically, I didn't make that much money in my prior career, and I'm still relatively young. I'm only 30. So I didn't really have much money going in to start this hedge fund. And I spent all of it on figuring out how to brand and advertise and video equipment and YouTube videos and script writing, whatever. So it's been quite the journey, but I've been yielding 100% of my income from trading, and I'm basically financing the business with trading and all that stuff. So it's been quite the route, but I'm feeling pretty good about it now after I've gone through it. And I've learned a lot, and the pace of doing stuff like that is pretty crazy. Like, people tell me like, oh, hey, what an accomplishment where you're at. It's like, well, it doesn't feel like it because I've just been so in it, but it's definitely chilled out a lot more where it is now. And, I'm a small hedge fund, but we're cruising now. So it's looking good.
Wow. That's a great story. And then why did you pick options, if you don't mind me asking, as opposed?
Yeah. I mean, I think a lot of people can relate to this, but it's like I was doing everything right. Like I went to school, I got a good degree, I worked a lot of hours, I like did the 1980s company man thing. I like bought real estate that the numbers panned out on a quadplex at a low interest rate. And I just saw like everything else around me just be affected by the overall, M2 and sentiment of the economy. And with that, it was also frustrating to see so many people that are working for, monkey JPEG companies that have 90x multiples and were like making money. And options was like the one thing where it's like you could make a huge return on this, and there's not really any bullshit about why that happens. Like it's the clearest line from A to B and the blackest, whitest thing. So I was attracted to that. It made sense to me. And as I did it, I was like, okay, this is the real deal. And after 2020 happened, which was a phenomenal year for trading volatility, I was like, okay, this is it. Like this works in up years, it works in down years. The time frame's so like, short, even with zero DTE, that within 90 days, like you're going to hit your expected returns if you follow the numbers. So I really got into that, and I was fortunate enough to meet other people. And, a lot of people ask me for whatever mentoring or coaching. And it's like the biggest thing was like, I would see people's stuff, I would study it, I would do the work, and then I'd reach out to them. And then it kind of just foster a relationship. Like people are attracted to passion and velocity of what you're doing. So that's how I got mostly into options. And I plan on just keeping it going, and obviously scales well. And I basically have no interest in doing anything on short dated SPX options.
Yeah, because it seems quite a linear path you've taken, right? I mean, I've spoke to traders that have basically been up and down for multiple years, some multiple decades actually. But it says like, COVID to now with what, best part of 5 or 6 years. And just from hearing you, it sounds like you didn't really have many ups and downs. Am I right in saying that? Or was it pretty?
Yeah. So this is like, and this kind of crazy, but I did probably 3,000 hours of self-development stuff. And like, I just wouldn't take no for an answer. But the underlying theme to all that stuff is the whole 10,000 hours thing. Like I'll talk to a lot of people that will say, I've been doing this work for 30 years. I've seen this. How are you reacting to Trump presidency? I remember trading before this. It's like, I wasn't trading during the last Trump presidency. I was like 19. You know what I'm saying? And it's when people tell me about that, I pretty quickly realized that when people have experience or they're not where they are 20 years into the game, they're just on the same lesson and they're learning it for the 50th or 60th time. So not really that I'm a genius or anything, but zero DTE is like especially, unkind to like the amount of iterations you do on a day-to-day basis. So for example, like when I first, like I've traded 1,000 straight trading days, and I make roughly 200 trades a day. Granted, they're all automated now. I didn't used to do that, but that type of repetition, I went through like individual stocks, looking at charts, using discretion, only trading one time of the day, to basically now doing what I call dragnet theory, where it's like if you scrape a dragnet on the bottom of the ocean when you go fishing, you pick up like crab, flounder, shrimp, and like cod. And when cod fishing's not good, crab fishing's good, scallops are good, scallops are priced more. And you're basically able to harness whatever is across that surface at any given time. But I would say the main thing is people aren't focused because they're working another job. They don't really take like an identity in what they're doing, or they don't have the accountability to where they can lie to themselves. It's like my product is cash settled at end of day. And I've basically pegged myself to a quarterly timeline. And just that clarity of what that is, it's like I instantly know when I'm off. And like I feel that is not acceptable with what's that doing. So I think everyone could get there relatively quick because there's so much information out there, but emotionally people just struggle with it, especially males. And this is in a book called The Hour Between the Dog and the Wolf. But basically like when males take risk, they bring up testosterone to prepare for that risk or that battle or that fight. This is prevalent in the animal kingdom and the human realm. Then when they take that risk, if they succeed, that further proliferates the testosterone feedback loop, which makes them take more risk and be less risk averse. And this eventually goes until it all rolls over. And it's the story of essentially every bull market. And it's a slippery slope. Like if you take that step and you've like sold something to your investors, or even if you've written that for yourself, like once you've done that, whether you know it or not, you've now rewired your brain chemistry to reward you for basically not following that plan. And this is essentially what everyone's doing. Like this is tulip bulbs, this is Bitcoin, this is all that stuff. And the longer those time frame investments are, like the more people are going to get bit and they can feel like geniuses up into that point. And it's like, I like to pick on Bitcoin, especially. It's like, I do kind of like Bitcoin. I think one Bitcoin equals one Bitcoin makes sense. But if the whole thesis behind it is like the government's printing money, it's like they only deficit spended 6% of GDP. Why is it up 100%? Like, are they making up for false time? And it's like the last time Bitcoin zigged when the S&P zagged was like 2008. Like in 2020, it dumped. 2022, it dumped. During August 5th, it dumped. So all that stuff, I'm just not really that attracted to. But yeah, people just aren't honest with themselves. And another thing with like males, like women are usually much better at following this because they don't have this, proliferated testosterone feedback loop. But a lot of guys also need to get like lined out by someone they view as like superior to them, and having the humility to realize that everyone you talk to is superior to you in some sense, or you can learn something from them, is also like the counterpart to that testosterone feedback loop and being able to adapt quickly as well.
Oh, I didn't know that. And even just hearing you talk for the last, I guess 10 or so minutes, I can kind of feel the mindset, and I would want to say Tony Robbins type. I guess the way you speak makes me think you focus on self-development for quite a while. It comes through in your language, I think.
Yeah. And the thing is, you could say self-development, you could say ego, but everything is essentially, if you have a treasure map, you need to be honest about where you're at, which a lot of people struggle with. You need a clear vision of where you're going and why you want to go there. And then you need to know what bridges that gap between the person you are and the person you're going to be. And the primary thing that guides those are like your words and emotions. So there's a huge difference between being driven by ambition and being driven by greed, And I also think people are like, oh, how'd you go from construction to, I'm not on Wall Street, I live in Texas, but doing that type of stuff. And I've talked to people that I met on LinkedIn or whatever that are, going to Stanford, they've interned at hedge funds. Like, I don't know what their life's like, but I'll talk to them like, how big do you think zero-DTE could do? Like, I've been studying this market since 2020. Like, you think you could do $50 million? And I'll ask them what their strategy is. And it's not very, antiquated. And they're just asking me, how much money can I make? How much money can I make? And you can clearly tell that that person is driven more by greed than they are ambition of what's capable, because they've constantly been rewarded from like being in that society and pursuing that. And not saying that that's wrong, but that's a reality that you may have to question is serving you when challenges come up in the future. Or like we were talking about earlier, you'll just continue to be faced with the same exact dragon that you eventually have to beat in a different form over and over again. And each time you have to restart from that point.
Yeah. I think it's kind of a refreshing, radical honesty you were talking with. And I think is having been someone that has, or when I left university, trying to get into investment banks. I later went to work for an investment bank, but at the time, me and the guys I was with, it was very like, I guess the prestigious place to be was an investment bank. Right? We were thinking that way, kind of not to do with what's possible, as you said, with your career or your potential. It's more, oh, it's kind of cool to be there. Maybe we should go and work there. And then, we were like 19 or 20, but I can kind of relate to whoever those interns are at that time, maybe not thinking the way they should be. Yeah.
And the counterparty to that too is, I'll talk to people as well. But when we think about how that occurs, there's basically, what you want, which is driven by your language. Is it gift? Is it ambition? Is that a greed? Then the other component to that is, what are the questions that you're asking yourself? Like, what can I do to improve this? What's the one thing I can do to move forward? Or why does this happen to me? And then there's how you use your body and how you behave. And if you are working in a W-2 job, for the most part, you are in a victim frame. Like, you think you deserve into salary just because you're there. You do this work and you think you get promotions. You follow whatever orders and don't think as creatively or critically as someone that's doing their own thing. and you're kind of rewarded from, moving in the political system of your immediate boss or whatever that is, and the opportunities they get more for than what actually gets you results. And I think that undertone that is present in a lot of organizations can like drastically disservice it. And I even realized this for myself. It's like when I got laid off during COVID, I was like, I'm going to learn options, and decided to just work through it every day as a very motivated person. But just from the fact that I got unemployment money and stimulus money, I could feel myself starting to develop that victim mindset because I was behaving in that form. And I took a job that, paid less than unemployment did, but I realized this is not good for my mental psyche to get paid to do nothing and start to being, expectant of it. And it's like, I needed to change what I was doing with my life and physiology to bring me in the route that's going. And comes back to the treasure map. Like, you could want to get into investment banking, but if you want to get into investment banking because when you go to the bars and you tell chicks that you work for Goldman Sachs that they think you're attractive, it's like, obviously you're not going to be good at investment banking. And with that frame, you're like completely screwing up everything that you're trying to do as well. So you have to be in congruence with everything you do. And I think people notice that when you talk to them and if it comes through as well.
Yeah, definitely. You can spot a phony a mile away, I think.
Yeah.
I think those people do get found out over time is one thing, not my direct boss, but a senior guy in the org, was kind of saying that those kind of people, they only get so far. But I've taken you on a tangent a little bit. I want to come back a little bit to your hedge fund. And a lot of hedge funds have, a kind of unique selling point, a reason why they get allocated capital. Like, for example, Jason Shapiro's, it's not a hedge fund, it's a CTE or CTA, sorry. They provide a kind of an uncorrelated return to trend following. And that's the reason he gets allocated funds. And for you, when you were starting your hedge fund, I guess, what was your USP that you pitched?
I mean, I think zero-DTE is pretty unique, whereas purely if you look at it, I mean, obviously we're trading options, obviously we're exposed to things, but the fact that only 20% of all hours in the week are during market trading hours, like, you can tell that's pretty damn uncorrelated to anything you're trading. And then on top of that, we're trading options every 2 minutes on the index. So it's so in left field on what that is. And the other thing is it's very, you can cater it to whatever you think is, applicable for what people would want. So like, I know someone else that runs a zero-DTE fund, and their pitch is zero beta pure alpha. So their beta is literally like 0.2 of what the S&P is, which is, insane. And they get market S returns. But I would say, particularly with that, it's like, who's your ideal client? And my ideal client right now is, it's like, you've traded options, you've explored zero-DTE, and you're making money in your job. And zero-DTE trading is a time-consuming act that requires automation and attention. So those people that already get zero-DTE trading can be like, hey, this guy can effectively do it for me. I never have to worry about it. He's probably better than it for me. And with the volume we're doing now with commissions, it almost completely disregards my entire 20% performance fee from volume discounts on commissions, because commissions and fees on zero-DTE are almost 25% of your P&L. So that can make quite the difference. But my more thing with that is like, it's dynamic. And I would ask you, what are your investments like, and what are you particularly looking for? Because the core that I think a lot of people miss with what zero-DTE has, and particularly what I'm doing, is whether you know it or not, you're triple long. You're long your job, that it'll continue to be fruitful for bonuses, promotions, your salary. You're long the stock market with ETFs, the SPY, the 401k, and the new big trends like AI or blockchain. And then you're long your house with a leveraged mortgage that's in an expensive area that's based on everyone else making money and bidding that up. And essentially the stance you're taking is that the house is price correct, the future multiples of the stock is price correct, and interest rate is mispriced, insurance is mispriced, and the volatility is mispriced. Whereas I'm taking the exact counter argument where I'm saying, no, volatility is priced correctly, insurance rates are priced correctly, and the underlying and future cash flows are drastically mispriced, which if you look at any chart of volatility over a period of time, it's clearly true. That's a good bet. Now, that's not saying it's as simple, because you need to manage against the risk, but very few people have that exposure in their portfolio. And that's mainly because it's difficult to do And until zero DT came out, it's very difficult to manage your size. So it was only available for people to run some multi-strat hedge fund with a minimum of like 5 to 10 million bucks. But with zero DTE, since with one contract, you may only be collecting $100. Even with a couple million bucks, you could fine tune the exactness mathematically of offsetting positions of what that is. And the margin is a lot more forgiving because you're using spreads during the day. So I've democratized, and other people could do this too, but essentially what I've done is I've democratized a multi-manager hedge fund with long vol, short vol, delta neutral, trend following, all that, all into one box that is completely liquid and has enough occurrences where we can hit a consistent return on a quarterly basis. And that's counter-cyclical to everything else you own.
I'm going to be honest. You lost me at the strategies there. You said within one house.
Yeah.
So you said long vol, short vol, trend following. What was the other?
Delta neutral. So
That's okay.
Straight short vol or delta hedged vol, I guess you could call it. And then I'm also margining like US Treasury. And then we're also kind of synthetic permanently long the market as well.
Okay.
So yeah, I run 18 strategies, which are almost mini portfolios within the fund.
And those, I'm this. So we talked a lot about zero-DTE. I will come back to it because I'm going to assume that the audience don't know anything about it. So we'll go through it at a little bit more basic level. But say I'm going to assume in that portfolio you're running different duration options plays, like trend following, for example. You play in a slightly longer period than zero-DTE.
Trend following. My longest trend following is 7 days. And then my shortest it's a trigger, so it could be like a couple hours. But the other thing when we're trading options, surface, it can get a lot more complex, where trend following in the traditional sense could just be like, it's just based on XPS price, like you're above a certain moving average. But with options, it could be based on signals of velocity of option pricing. So if a call goes from $2 to $8, that could be a proxy to buy a call. You know what I'm saying? Obviously you test it and you look at that. Or if, we do something on Mondays and Fridays, there's a weekend effect and it can affect that. But we could also be triggered by volatility. So when we hit the expected move, that's a type of mean reversion. And then that could be, counterintuitive to whatever your delta neutral trade is. But you have a lot of options of how you could look at to trade those. And the fact that you're not in it overnight and you're holding instruments, let's say if you're long call that can have unlimited upside and, it may use 0.5% of your net lick, or you could trade a short option that options decay into expiration and will expire at 1 or 0. And you can have a broker resting stop on it to where you could get out on a small move. So the time frame of that trend following is still related to the expiration of most of my options, which are zero DT. So you could think trend following at the end of day, which is nice for uncorrelation because in a lot of days, if the market were to sell off by 1%, volatility is priced significantly higher. So you could take a trade at 3 p.m. and the market could not move at all. And that could be like a 1% return on that trade because you're playing the expected move of the market, which has nothing to do with the market on such a short time frame. So it's a unique niche of what that is, but everything is predicated on the fact that options, increasingly decay going towards expiration. So you can, I'll call it like theta trend following. It's like, it's going to burn if it doesn't move down another 0.5%. So you can basically use that. And if you've, ever been to casino, they do this too. They want you to bet the table limit, or less than that, so they can keep their bet size similar. And the more occurrences you make, the closer they're going to get to their expected return, which is essentially what I'm trying to do by making so many occurrences and basing that all on the data that we have from, back to 2016 on zero DT options of what is the best way to do this and how these offset each other in a small portfolio.
Yeah, that concept of theta decay, I always found really attractive because that is the hardest part of options. I mean, we've mentioned before we started recording, that my first experience trading was with options, like trend following based on price. Although I find it an interesting concept when you talk about options velocity and then trend following based on the option pricing changing. Is that right?
Yeah. I mean, I'll give an example of something I do, and it's not that crazy, but this just shows you the capital efficiency of options is the free lunch of the options. So if we look at a very popular like way to think about making money in markets, we're looking at the expected value equation, which is basically, win rate times win size minus loss rate times loss size equals our EV or expected value. And where a lot of people mess this up is we're looking at the dynamic form of options is they'll say, I'm going to use a delta target. So now their average win size and loss size is completely different because volatility scales with time. And then they'll use a profit take, which will fix their average win size, but they won't use a stopwatch, which will fix their average loss size. So you could see how all the inputs into this equation, even if you're right with your data, you're going to get a hard to measure output of your expected value. Whereas when we marry all those things together in a small portfolio, we could see that we can make money. And the example I'll give is if you go long straddle, like 1 day to 14 day, it's roughly break even, like expected value, no management, no nothing. And people can grab it about back test, but when you have no entry parameter, no exit parameter, and it goes to expiration, that back test is going to match 100% and it never excluded any days. So you basically have some type of long vol suite that will break even over a period of time. And when we look at volatility and options, the at the money volatility or buying a straddle is going to be the most accurate predictor of future price. Then out of the money options have what's called skew. So if the at the money implied option is a 15% move or 15% IV, the 10 delta put may be a 22% IV. So if you sell two 10 delta puts and two 10 delta calls and you buy one 50 delta straddle, all of a sudden, like you've basically arbitraged the vol in the market per se, because we know the at the money vol is accurately priced and we know the out of the money vol is more, inaccurately priced or has more of a skew to it. The problem with this strategy is you obviously can't run this at like 8x notional, because if COVID were to happen and you had like 20 lots on $1 million account, you would get completely blown out. But if you were to run a back test, if you ran the short options at 2x notional and the straddle is 1x notional, meaning SPX 600 grand instrument, go to 600 grand account, traded one straddle and two out of the money options, and you just traded that every day with no management, it has about a 25% yield on the money you basically sold or bought as credit. So if you bought a $5,000 straddle and you sold $1,000, two out of the money strangles, you would basically anticipate to keep like $1,500 of that, or 25%. And the route is actually quite rocky, but when you combine them, it's nice because the straddle will go up and down, 5% drawdowns even, 5% returns even on your account. But the out of the money options will basically win for 2 weeks in a row, and then they'll have one big drawdown. And when you get that size ratio right and combine those together, you've just created something with a better Sharpe, a better like Calamar than the market, which is the return versus the max drawdown. And in order to get a 5% return, if you have portfolio margin, it uses probably 5% to 7% of your capital, maybe 10% depending on your broker. And it's like, that's great. However, you could never run that more than 2x notional, because if you ever take that drawdown like in 2020, which you would never know, and like we talked about, some people could stay out and that's talent. But the only way to guarantee you get your return is you never skip a day, you follow your management, and your long volatility that you enter is at the same time as your short, and it's married to one another. So it's as true as daylight. But if you think about that, you get a 5% return doing that. And you could also margin treasuries 99% for no cost, 10% return with the worst drawdown of 5% during 2020, running that. And if it tanks down during 2020, you're collecting 5 times the credit at those same deltas. So you're essentially, responsibly martingaling down to that, but you're continually hedging. You just need that size at the beginning. And this is my whole kind of thesis with options, is if we're going to make money, we need to basically have an edge. And how we could define edge is developing a more accurate price in the marketplace and then being able to protect against that risk for long enough and enough occurrences that you could realize the money you make. Well, it just so happens that options are already overstated, whatever is quoted in the market. So if you could figure out how to manage your risk, it's mostly done by sizing and diversity through trades, because that is free. The free lunch of returns is diversity and sizing. You can extract that from the market. And I know I kind of make it sound simple. It's not, but I just wanted to dumb that down. It's like we can determine a price just with the market's quoting, and we could essentially arbitrage the price by the at the money volatility we knowing is accurately priced, and the market offering us more out of the money, and we do that. Also, to preface it, this would never work on like a single stock because unforeseen things could happen. But when we do this on the SPX, if DeepSeek comes in and is the new leader in AI, like SPX is going to buy that up. And if Jensen Huang gets shot and NVIDIA goes down, like the SPX is going to buy Broadcom. You know what I'm saying? So this is also constantly rebalanced on what's going on. It's like if the financial sector fails in 2008, but oil goes to $140 a barrel, Lehman Brothers go under, ExxonMobil is the most lucrative company in the world and is bought up by the SPX. So you're combining indexing the risk-free rate like you did in a high yield savings account, and then, we'll call it quantitative arbitrage or whatever on pricing as well. You can do that. And you start stacking those on top of each other, and all of a sudden you can make a very attractive portfolio.
Yeah. Yeah. And you know what? What's striking me is it's kind of like super smart risk taking. That concept of, if you come up with a trade idea and you want to be long SPY, for example, I guess some people would reach for the ETF, some people might reach for MES futures. But just listening to you, I think options seem to bring that additional dimension of risk management and kind of skewing the odds in your favor when you're putting different things together, different types. I mean, I'm calling them strategies, but I mean straddles, strangles, options kind of plays.
Yeah. I mean, it is like there. And the nice part about it too is if we're looking at investments, what the flaws are with them is a lot of people like buying real estate because a red and green quote is not being on your phone for what's happening with real estate, Jay. And no one's being like, ooh, like Mulberry Lane, tank it, sell. Like the price is going down. Like no one's doing that. So it's mentally easier to hold it. But the fact that there's not a price being quoted on it, it's much harder to protect against any risk or avoid any contagion. Be honest with yourself because you don't have the opportunity to protect against that risk. And even if you do, it may only happen once a decade, where I'm doing that several hundred times a day, and it helps you learn faster. So it's not like it's easier, but the method in which you can consume that is like much more beneficial. I think a better example of this is if you wanted to be, a world-class 100-meter sprinter, it'd be really frustrating because only when you're super fresh every 4 months, you can like try for a PR and you may beat it by like a 1/10 of a second. And it could be windy that day and you could run great and would not hit it. But if you're a distance runner and you ran like every single day and, a marathon is 4 hours, you could improve by 20 minutes or 5 minutes a week when you're starting out. You know what I'm saying? And mentally, again, that reward loop just makes it much easier being like, oh, I know where I'm at. Whereas most people will be markets shooting up, people are like, oh, long the US, and everyone's doing that. And people have been rewarded for it and they're going to continue to get rewarded for it. But it's just like that, selling the strangle. It works 99% of the time. And then when it doesn't and it turns, it can completely obliterate your account, which will what's going to happen to a lot of these. Like I think Tesla's down 35% from the election high already in a month. You know what I'm saying? And it's like, ooh, that hurt a lot of people.
Yeah, 100%. You mentioned as well, like the amount of trades you're taking a day, something like 200. Now, one thing about trading often and day trading and day traders I come across, not that, well, technically you are a day trader, but you do it systematically, right?
Yeah.
Yeah. It is the ramp up in cost. I think you said, I don't know if it was before the call, that I think the spread is 25% of your P&L or your trading principal commission.
So the trading, and I have a chart like this where it's like 99.9% of people lose money trading zero-DTE options after commissions and fees. But roughly commissions and fees, if you're keeping $10 of every $100 you sell, which I would call a premium capture, if you sell $100 of premium, you retain $10 of P&L. At a 10% premium capture, about 13 to 14% of your capital is spent on just commissions and fees to execute. So you're paying that to your broker for taking no risk. And then if you're at 5% premium capture, or $5 every $100 premium you sell is P&L, you're closer to like 23% of your P&L. And on top of this, you pay for wings, or if you sell like a $2 option, you would buy a 5-cent option to cap your buying power. Because to trade a one lot of SPX, it takes about 80 grand in buying power. To buy a $5 or 5-cent wing to cap your buying power, it's usually around 15 to 20 grand to do that. And when you factor that in, that could be close to 50% of your P&L. So about 60% of your P&L is spent on commissions and fees and capping your buying power. However, the counterpart to that is that I could trade 200 trades a day in a well-diversified portfolio that normally people couldn't do with less than a 9-figure account every single day. instantly transact and being able to, lift my bids and get out whenever I see fit. So you've traded like efficiency for a time velocity of money that is better than anything else you've effectively seen. And also, if we go back to the margining of treasuries, I think last year I spent roughly 350 grand on commissions and fees, and on interest, I got paid like 340 grand or something on interest on treasuries. So even though that does have a lot, the options margining is kind of the free lunch that can help out with that. But this goes back to the thing where it may sound easy, you could execute this, but if you're trading something 200 times a day and you decided to pay for a 10-cent wing or a $10 wing to cap your buying power as opposed to a $5 wing, you could cut your profit down by 60% or something. And if you're not checking everything daily and you're not as data driven on what you're doing, you could get into trouble pretty quickly with what that is. But, you have to view how much does my investment get quoted? What's my ability to responsibly leverage this investment? How easy it is to know my price so I can therefore protect against my risk? And what's the cost to transact to get in and out of that? And then how quick can I redeploy that money? And that's kind of what I call like the shield of an investment and how to do that. And an example I like to give with private equity is in private equity, they say, oh, we do a 20% return. Well, it's like they're quoting an internal rate of return instead of a compounded annual growth rate. So if they don't call upon your money for 6 months and then they call upon it and they did a 20% annual return, but you were only in it 6% of the year, you only got 10% per annum for that return, basically. And this is where a lot of people in the finance space try to trick you or whatever that is, or a lot of people that own, even the S&P, I don't know what the multiple is, like 27x or whatever. Every company could potentially hit their earnings and we could make no money over the future because that's what it's driven off of. And when you're trading zero-DTE, it's like there's no sentiment involved in my P&L. If I sell $1 million in premium, I retain $400,000 of P&L. The return's $400,000. It's not multiplied by anything. It's 100% in cash at 4 p.m. And that's the return that's basically given to everyone, which is a nice change of pace of what it is. And that's why I kind of like it. It's not bullshit on what it is.
Yeah, it's a great point because I guess the longer term, we talked about long term, just buy and hold, is susceptible to so many factors, changes in sentiment, earnings, geopolitical risk. And I mean, when you close at the end of the day, it's the end of the day and that's it. There's no overnight risk or weekend risk or gap risk. Now, I have 2 questions, but the first one I want to cover first. Obviously, it's the first question. But so people watching, I think, may be trading, say, futures or FX, or they may have long-only ETF portfolios. How could they use zero-DTE options to enhance their P&L this year?
I mean, like how I speak about it and what I do, I don't think most people should trade like me. And people are like, oh, it's systematic. This is great. You take all your emotions out of it. It's like, you don't take your emotions out of being systematic. It's like, I may not be looking at charts and like gritting my teeth if I should let my P&L run, but I have to look at hundreds of hours of data to determine I want to program something and run it. So there's a lot of work with what I do into it. It's just scalable. Whereas with zero-DTE, I think if people wanted to add one strategy, like I talked about the straddle strangle, you would need a big account, like at least $500,000 to do that. It could be beneficial, but that short dated stuff you could get on Option Omega and test a few things. There's good examples. I have like one trade, which is basically if the VIX opens up overnight, hence the thesis behind it is if there's a lot of rich volatility premium that occurs overnight. So if that volatility doesn't come out from the 415 close from the prior day to 932 when it opens, then it has to come out before the end of day and it's probably bid up, which in any backtesting software, if you ran it, it's very lucrative and I manage each side with a 4x stop. But if you have a 50 grand account and you don't want to pay $250 a month to automate and have a backtesting software, it probably doesn't make a lot of sense for you to log onto your phone and do that and be stressed out on what you're doing at work. What I actually think is more well suited to a lot of people is there's starting to be a lot of really good exchange traded products out there. So like skip the individual stocks, look at buying a potentially, 2x levered S&P fund or something like SSO or even SPY. And then a lot of brokers let you margin a treasury. Look at SVOL, which just shorts the VIX, which is a very good bet. It could just be a little volatile, which you could throw in your portfolio. I think there'll be better ETFs out there in time But I think that's how people should look at their portfolios a little more dynamically, of using leverage in a responsible way. So instead of being 60-40 bonds, say, I'm not going to take the interest rate risk on a 30-year bond. I'm going to hold a 2-year bond with no interest rate risk. And to make up that 2% return, I'm going to leverage like 10% of my portfolio to get more SPY exposure with a 2x leverage SPY ETF or something. And then I'll take something really uncorrelated, which is like ticker CTA or ticker SVOLE, which is, I simplify asset management, where it's like, ooh, let's put this in here. And I think that's a much more attainable way for people to look at stuff than to try to trade zero DTE options. There's also a lot of good, they're called business development companies that basically lend out private credit to small to medium businesses. And they'll yield like 10% dividends and stuff. But get your taxes in order, and look at more stuff like that, where I don't think most people should be trading options. I mean, if you really want to, you can go to my YouTube channel and there's, probably like 10 of them you could just take. But it's just a recommendation, and you have to be the person that's going to execute that every day. And if you skip a few days because you get scared or you have too much of a losing streak or you don't know where you're at, you're only going to get the results of what you follow through with.
Yeah, well, didn't expect you to say that, if I'm honest. Yeah. But it's...
I really like it. The more people I talk to, the more I realize that what I'm doing and my goals are not the same of what most other people are trying to do. I don't think it's complex to figure out. There is a lot of good information out there, but are you going to stick to it, commit to it when there's not that reward, and do it until it kind of makes sense of what you can do,
Yeah. Very sensible, I think. Well, zero DT, and I think it kind of sounds like you're talking about trading, I guess, in general, in the sense that people think about trading very short term, hit it and win kind of gambling type mentality that's kind of mainstream about trading. I think, unfortunately, it is best if a lot of people stay out of it. Like, I had a guy at work ask me, what's all this about? I need kind of some extra money for whatever. And I was like, well, don't look here, as in, unless you've got 3 years and, I don't know, 20 hours, 25 hours a week on top of your job. And that's being quite conservative. Yeah. Bro, don't bother. Right.
Yeah. And I don't mean to disservice people or discourage people, because obviously I came from nothing and people can do whatever. But
sure,
what I like to say is, like, trading is a gladiator sport. Like, the more you play, the more likely you are to die. But the people that figure it out and get there are rewarded at such an exponential rate that they eat up such a massive market share. Like, it really is the truest form, I think, of capitalism that's present out there. The only flip side with zero DTE is, like, the nice part about zero DTE is that, liquidity is not available to billion-dollar hedge funds, because that's just not how stop loss liquidity works with resting orders in the market. So even though I may sound advanced in what this is, it's like, we're not competing against the smartest Ivy Leaguers in the world at like Renaissance Technologies or whatever that is. Because even if they did 100% with no drawdown, it'd be a rounding error on their portfolio. It's like Warren Buffett can't buy small companies. He has to buy the mega caps because he's got so much cash. So that is the one underlying thing that I think is exciting with systematically trading zero DTE options, is it is a little more of the little guy's game, not giant Wall Street institutions. Like, for example, I think right now I'm about 150,000 of SPX daily volume. I'm about 125,000th of the SPX volume. And, that's probably like 10 million bucks of assets currently what I'm doing. So you could see how large institutions aren't going to be doing that. And the democratization of backtesting software and automation has come down to, you do it for like $300 a month with like some really good stuff. And that probably used to be 300 grand a month, 5-10 years ago. So that's exciting in my perspective. And that's why I jumped into it, because I kind of thought it was this little bit of a gold rush, and there's a lot of bodies along that trail. But, I'm in a lot of discords with several hundred people that are consistently plugging away at 30 to 40% returns with less than 10% drawdowns, like year after year for like 4 or 5 years in a row.
Wow. Yeah. And is it that using your strategies?
I mean, I also
just in general.
Yeah. I mean, I also like to demystify this. It's like, there's only one movie going on. Everything's a combination of a put and a call, and it's all vertical spread. So my main advantage is, like, I, have a little bit of a math background with a lot of analysis that I've done, and I can really look at backtest to know how well they'll match the real life. And then I have a big enough account to outlay all those strategies. And if you have a 200 grand account, you may be choosing between a 1 and a 2 lot to offset your, potential risk. And when you do that and your variance is twice the size putting in that trade, you're obviously going to deviate from your expected returns. That could be significantly better and it could be significantly worse. So I'm not really here to try to be the best trader on earth. I've optimized everything for conviction, not blowing up, and basically having a 45-degree line. I can call, I get about a 10% premium capture. I do about, 50,000 contracts a month in trading. And I've consistently hit my exact return target on a 90-day accuracy for, 2 years basically. So it's a different way of thinking about trading, but that kind of shows you the consistency of the math and the law of large numbers and what you're doing. Although it's not as exact of a science to people with smaller accounts, but you could do way better than me. You may pick the right trades,
Yeah, but it's taking that part out of it, that it's not about picking the right trades, right?
Yeah, it is professionalized very much as a business where a lot of people go to, exact their gambling sense of what that is on a day-to-day. The way I almost kind of phrase it is a lot of people, go to try and get rich in the market and they want to come in quick, where I think of the way I'm trading more to Olympic athlete. I do the things that I need to do each and every single day. And at the end of 4 years, I should be exactly where I need to be, on the set Olympic stage or on that track record for that 4-year period. And that's just a different mindset again of where I'm trying to go, what emotions do I need to get there, and how do I behave each and every day to accomplish that.
So am I right in saying that because the margin requirements are so high for your zero-DTE strategies, it's not as applicable for a lot of people, and the kind of goal is to scale and do volume?
Yeah, I mean, it's very attainable to people with smaller accounts because you could trade a 600 grand instrument with no risk overnight and you could have a $50 wide spread. So it used 5 grand. So obviously people with really small accounts could do it. However, the options are so extremely accurately priced, especially because they're SPX and they're cash settled. And on the day of expiration, there's very little unknown because the overnight session already happened and you can transact, that if you're going 50 wide on a strategy, let's say you're selling $2 of premium and you're paying 20 cents for your long wing. So you're buying $20 of what you think is expensive that you're selling for $2. Whereas if you had a much bigger account, you could buy a 5-cent wing and now you've exercised that, much more clearly. And the environments change very quick. So your trade that made 20 cents on every dollar you sold could now degrade down to 5 cents on every dollar you sold. And all of a sudden you get some more slippage and you're not making money. That's why I use, I was talking about the dragnet theory. Whereas if I have 20 different strategies, long fall, short fall, morning, afternoon, small stop loss, big stop loss, delta neutral, trend following, I had 3 of my 18 strategies in the portfolio lost money last year, but 3 outperformed. You know what I'm saying? And it's some days the week did well, some days the week I just hemorrhaged money on. But since you have those so much balance, those ebbs and flows and zigs and zags get a lot muted out over more time with more strategies. So that's that certainty of making money. There's a lot of people that are complete idiots and come in when ball's high and they do 30% a month zero DTE and they think they're the smartest people on earth. You know what I'm saying? Or if you would have traded consolidation, post the big election run up, you would have made a lot of money, or rolling stuff out each week. But you could get hit with a 60% drawdown. And when you're trading every day, the numbers play out.
Yeah. Could you give me an example of those 18 strategies? You kind of remind me a little bit of Tom Basso. If you know Tom Basso, the market wizard, he basically was talking about, the concept of filling in the potholes on a P&L curve, that no strategy makes money all the time. And in the times that one isn't making money, that it's being offset by another one. So I think for your portfolio, is there 2 or 3 strategies that work particularly well together and that offset each other or provide kind of uncorrelated returns?
Yeah, I mean, I would say here's another interesting concept with zero DTE is I'll say delta neutral, but delta neutral is trend following with zero DTE because you're using stops. So if you traded a 10 delta condor at every half an hour, let's say, and you used a 1x stop loss, if you're lifting the call side or the put side when it doubles in premium and you think there's risk, you're trend following. You're just trend following through stop loss because you're taking that position off. So having those neutral condors is a good core, but to offset that, what would do well on that. And a lot of people would be like, oh, we're going to trend follow, like let's call it EMA or move, like every 10 basis point move since the open, we're going to trade. Mm-hmm. And when you do that, if you're only trading credit trades, you've stacked up this huge amount of risk on one side if we get a reversal. And if it keeps trending, you don't get paid that well for it per se, and you're still holding the risk. Now, if you were to trade that condor and you did some trend following and you bought a call, now all of a sudden looks good. Or the simplest example is in a bull market, being long call pays very well, because even though the VIX goes down, which juices down volatility, the volatility is significantly understated, especially when it goes to the upside. Like fear is when volatility gets overstated. So like selling condors because puts are just overpriced and buying calls against that is a very good strategy. Like I could line it out more, but I feel like people make it confusing and they won't size it right. But generally speaking, any call over 7 days in duration, if we're in a bull market, which we've been in for the last 20 years, it's going to make about 10% of every dollar you put into it. It's just a question of, now that you have something, a hedge, long vol with positive expected return, essentially free margin, how do you overlay that risk that looks good? And I would commend people to test that. But the trick is volatility decays faster, closer to expiration and further out of the money. So you take, let's say, a 20 delta long call at 14 days in duration, and then you want to sell stuff shorter in duration than that, further out of the money delta wise. And that is kind of going to base it. And like puts, you close your eyes and sell something and it's going to make money. I guarantee it. But if the market goes against you, yeah, it works until it doesn't. So you have to think about that more. And buying long puts is a tough business, especially if the market's going up. Even if the market's going down, it's tough business.
Yeah, speaking honestly about my options experience, I don't think I've ever naked sold a put. I've worked in credit spreads, like buying a call and selling a call in one trade. Just proper, basic bitch, but never just sold flat out. So in terms of managing that risk, when you just sell a put straight, you obviously bank the premium. And how do you manage the risk of the put you've just sold? And apologies, it's just a really basic question. But
yeah, I mean, so we need to think of it in two ways. So we need to, like, we can manage the risk with just a straight stop loss. So you just put your order in. Liquidity is great, especially on the put side, and SPX is deep and liquid, like you're going to get out. However, there's those scenarios when it's going to go past your stop and you need to budget some money to offset that potential risk of ruin when that happens. And the two simplest ways to protect against that is basically being long straddle, because you're going to make all the dollars of money down until you get on that put. And also if the straddle is basically break even. And then the next solution to that would basically be, you need to be longer units of the SPX. So you need to have more contracts. They could be one deltas, you know what I'm saying? But you need to have like two for every one short option contract you have. So I guess everything I trade is vertical. However, they're like synthetically naked, where I may collect $2 of risk and premium and I may only spend $20 on long options on insurance. But those would be the simplest way. And then also sizing. But you start to balance out, if I have 3 lots of short puts, but I could redeploy those every single day, you could do a lot of damage trading 1-DTs like that compared to trading 1 45-day out. You know what I'm saying? Even though it won't bite you as much, because even though you have more risk, you have it on for a lesser period of time. And all of a sudden you start to balance out. It compounds faster. And since I'm at a smaller size, my drawdown is lesser. And this is the whole thing that I'm kind of doing, is take a 10% drawdown, you need 11% to gain back to even. 50% drawdown, you need 100% gain to get back to even. And if you make 20% over a year, and let's say you're doing 2% a month or whatever, once you get 20%, that next 2% month is actually like 2.8% or 2.5%. Don't quote me on the exact math, but math is an exact science and trading is an art. Whereas when we focus on the difference between our compounding and then the money we have to pay to get back to even from a drawdown perspective, that's where we can really harness a lot of edge with the portfolio. And I know this doesn't sound great, but if you have that much velocity of money and that much synthetic leverage with options and zero-DTE, you can actually win a zero-sum game. It's called Shannon's Demon. 2 non-yielding assets can basically yield a positive return by reducing drawdowns. And I'll try to antiquate this to people as quickly as possible. But let's say you had 2 games or sources of income that had zero expected return, ignoring for inflation. You had cash, $100 equals $100. Then you had a coin game. When you flipped it, if you hit heads, you got a 50% return. If you hit tails, you had a 33% drawdown. Because you need to take a 33% drawdown, you need a 50% gain to get back to even. So that means if you're just playing the coin game, you would go from $100 loss, you're down to 77. You need that 50% gain to get back to 100. If you win, you go to 150. You take that 33% drawdown, you get down there. So basically by doing that, if every time you won or lost, you rebalanced half of the money into cash, and you always balanced out how much risk you had exactly each time, you would eventually get a positive return over those iterations basically of that game from two games that don't yield any money, because all you've done is you've controlled your drawdown. That's a very extreme example. People don't take that large of drawdowns, but that just shows you the power of investing on such a short-term time frame, because this is essentially what everyone's doing in their 401k with their Roper advisors on rebalancing each year. But if your assets are moving much faster several times through the day or every day, you can get that same effect daily, which compounds more and more and more.
Yeah, it reminds me I think I watched a video on arithmetic versus geometric returns. But I hope it does two things. I hope it hammers home. One, on your strategies is mainly for people watching about how much of a science you've made this. And it's not like you're going and just shilling loads of zero-DTE options. It's like an exact science, super systematic. And the other one is drawdowns. As you said, if your mark to market is down 40% because you couldn't handle a drawdown, coming back from that, and if you have a mega strategy that 40% drawdown and it's going to yield 200%, if you hit that 40%, it's not that it's over, but it's a long way back, right?
Yeah, and it also just kind of makes sense. And the other thing that I like to champion out there a little bit is we see this traditional investing culture. Bitcoin, you buy Palantir, you can add an S&P, Elon wins the election, you buy Tesla. And it's like, I get why people are doing that. It's like the world has gotten really expensive. I think it's an absolute crime that not so much there's per se wealth inequality, but like people are constrained by their age to have families, predominantly women, but guys are part of that. And it's like, it's a crime that people can't get enough money to afford to have a family in their, late 20s and early 30s. So people are trying to take risks and getting ahead while working, and they don't have time to allocate to this stuff. And those people are pitching you on the 1 in 100, and there's 99 bodies along the way. But if you can make 20% a year or 25% a year instead of 10, you need like 1/5 as much money to get that exit velocity, kind of like escape the rat race or whatever that looks. So like there are other more responsible ways that make sense to start to get on this path that don't involve just a huge amount of risk, or you could take risk more responsibly. Like the example I like to just hammer all the way is it's like, don't pick NVIDIA. You know what I'm saying? Like don't pick Palantir, like just take 2x leverage on the S&P with an ETF that'll do it for you. And it's like, you wouldn't even blown up in 08. It would have gone close. It almost would have gone to zero, but that was, we're not really worried about 2008 per se. And like the Fed's going to bail you out. The Fed's going to bail out the FTSE. The Fed's going to bail out the Nikkei. The Fed's going to bail out the S&P. The Fed is not going to bail out NVIDIA. They're going to let NVIDIA tank, and they're going to buy up Broadcom. So that type of risk is attractive. And if you look at the S&P, if you just would have bought the S&P on 2x leverage last year, I don't know, I think it would have been like 60 something percent, And sure, in 2022, did you take a 40% drawdown? Yeah, but you beat the market over that period of time significantly. It's not, you don't exactly return 2x the return of the market over time, but use half the capital to get like 1.8% of the return, which is quite attractive. And what else could you use that capital for? And this could even be as simple as, okay, let's put half as much money in your 401k, and then let's take that other half and buy the 2x leverage SPY. And even with the taxes you pay, you're going to have more money than you would have if you put it all in your 401k, and you could have it to use it now on a house or doing a nice vacation with your wife or something, and that's what more juices me up of financial freedom than being like, hey, I went from a construction worker, hear my story, you can be a hedge fund manager too. It's like, that doesn't really serve anyone. I'm just trying to cut the bullshit. It's like, I like take my YouTube videos, make some money. I'd be more than happy to do that. Work your job, allocate some money to me as a manager if you trust me for whatever. But like the simplest thing is hodl 2x S&P at a responsible size, and it's like, I even do things mentally. It's like I have an auto withdrawal from my account that buys S&P every month. And I have a second phone that I have locked in my storage unit, like 20 minutes away from my house, that I need two-factor authentication on to change that allocation. And like, if you did that with 2x S&P, it's like, this is a much better investing strategy than like learning how to look at candles and wicks for whatever that is and get very productive at your job. Because even though I'm trading for a living, I'm actually much more interested in the entrepreneurial pursuit. Sure, hedge funds is where I'm starting, but that's where I'm at. But like, I've invested much more money in trying to grow my business in the fund, and I would have made much more money if I just bought back equity and return on capital trading personally. But that's not really what I'm trying to do, as a person impact. And the other thing I like tell people is like, money is cool. It buys you time and it buys you freedom. But wealth, which is like the passive generation of that accumulation of money, is the same to time and freedom as it is to your impact and reach. And that's what I think a lot more people should go after, because if not, rich people are just going to own everything. We're just going to be wage slaves to paying them rent, borrowing their money, buying more of their stuff. And this eventually needs to change.
Yeah, some awesome points in there. I think, to sum up that point on leverage, and of course, options are leveraged instruments, but it's a great message to take, maybe drop the traditional buy and hold, which I do fully believe in for most people, because most people
just not 60-40. That's dead. 60.
Oh, absolutely. Absolutely.
Short-term bonds is fine. And like, I'm also a big advocate. It's like the Feds bails out the credit market. So it's like, look at some private credit funds, like even like agency-backed MBSs, like get a little bit higher yield on that, but like do not carry anything like over 2 years in duration. And like, it's crazy to me, some financial advisors still recommend that, but
what do that mean by don't carry anything longer than 2, as in don't hold
you have interest rate risk. So like if interest rates went up 2%, your asset that's yielding 4% could be slashed down in value by 30%, which is like, we clearly know that's not a good risk to reward. Whereas if you hold the front end, like 2 years in duration of the yield curve, you may get 75 basis points less yield, but you're never exposed to rate risk, basically.
Yeah. So so you mean not that you wouldn't hold, say, the S&P for longer than 2 years, but don't lock yourself into a bond and take on duration risk.
Yeah, like 60-40 bond is like, make sure those bonds are short duration. And like, I'm also not too worried about, like investor grade bonds, private credit, like they have a low default rate. They're obviously not the Fed, but you can just kind of see that that's not responsible. Like in 2022, it was the worst year since 2008 for 60-40. And that's not changing. It's like, they're probably not cutting rates. And even if they do, it's probably not that great, Yeah.
A lot of people talking about credit at the moment, and there's super low spreads between investment grade and high yield at the moment. So yeah, I don't know if you're kind of giving long-term advice, but it's very timely advice. I'm not sure if you meant, if you're following the credit markets at the moment, it's a lot of people talking about credit and private credit at the moment as a great investment.
Yeah. This is like a macro thing, which who knows when it plays out. But basically, the US it's the world. Like, it's going to influence Europe. It's going to influence everything else. And basically, like, we're in such a massive amount of deficit spending that if we continue to deficit spend, like the government wants to lower rates because they have to refinance their debt. And like, it's unsustainable if they're paying more than 3% of their GDP on interest, basically. It's like same withdrawal rule for you during the retirement as the government. So if they don't cut spending, whether they cut rates or not, the credit market's going to call bullshit and push the back end up. It's going to steepen, which will already happened. Yeah. Which will hurt the actual economy because people will have to spend more borrowing cost. And the government could potentially institute QE, but there's no way they're doing that. I don't believe it. We'd have to be in economic turmoil for that to happen. And then the flip side is they actually cut spending and actually cut deficit spending. And then they can lower the rate, which will bring down the 10-year also, or the benchmark rate. So money will be cheaper in the economy. So the economy could potentially make up for the lack of deficit spending. But that's basically what we're looking at. But that's going to be played out through a longer period of time. Personally, I don't believe anything they're doing. There needs to be like a big change, and Trump can say all this stuff. Elon Musk can change all this stuff. But it's like Congress actually approves the spending. So unless the Supreme Court just says, Trump, you have the powers of all 4 branches, which I don't think will happen, Congress will eventually have to pass this stuff. So as we see that not play out, we're going to see that steepener. And I think it's going to cause a lot of turmoil. It may not be this year, it may not be next year, but that's the overall path that we're going on. Is we're at an unsustainable level of this, and we need to change what that is. And the credit markets are the tail that is wagging that dog. So, I mean, if I was a global macro guy, I would go like short S&P, like long credit. You know what I'm saying? Like long yields or something on that. I know that's not super correlated, but like I would hedge my short S&P with basically rates, because I think that's what is ultimately influencing everything. And, like Peter Schiff says this, it's like, I don't care what your political view is. It's like, we can't afford our government. So it's like, you want the government we want? Like, I'm fine with that. Like, we just have to pay for it. So it's like, everyone needs to raise their taxes, and it's like, mathematically, if you raise the richest people on Earth's taxes to 50%, drawdowns, if they lose 50% of their money to taxes, they need 100% gain to get back to even. The next year, you're going to have that problem. Like, well, rich people that don't have enough money to tax anymore. Like, you're destroying your tax base. So we have to stop spending. But yeah, that's what I think is going to happen in credit markets. Therefore, be careful holding those longs, duration bet.
Yeah. And you take one look at TLT, the 30-year bond yield, 30-year bond ETF, and it will prove your point, right? How challenging it's been for the bond market, and holding bonds just to be awful, right? Now there's So I think playing short equities is difficult too, because equities will go up.
I'm not trying to stand in for that. For sure. Like covered strangle, like I think could be attractive for being long call. Like being long call and selling calls above that could be attractive too. But if that's not as attainable for most people, like I wouldn't freak out with people's S&P stuff unless you were close to retirement, in which case I would definitely think about collaring off some risk, like sell the upside,
Yeah. Like I'm fighting my short equity, spidey sense at the moment, because I've got burned previous years trading short equities, and now I don't do it unless I've got quite high conviction. But right now is a time where S&P's right at that all-time high level again, which statistically is like the best time to be long. Right, when an asset's breaking all-time high, statistically, it's like it's the best long, almost the best long you can get. But at the same time, it's very hard to execute, and because I feel like context is very important. The question I ask myself when we get to new all-time highs is that, or trying to break a new all-time high, is that, have we got enough going on that this is more likely to break higher or to fake out lower? Because to fake out lower, it just kind of needs to stand still and people kind of panic. To break out higher, usually we need a catalyst to break through that level and then push up, and then whatever, sky's the limit. And that's where I'm in my own internal debate at the moment as to what direction we.
Yeah, I actually think that takes funny, because like from what I look at, it's all driven by the options market. So for example, it's like the ball is out of the market. So when dealers, like when someone buys a call, dealers need to buy calls to hedge against that upside risk because they're counterparty to that. But this week, OPEX is normally bearish. So we're coming into OPEX on Friday, and it's like we're so suppressed in vol that any type of catalyst for downward move is basically going to raise volatility, which will cause dealers to sell back their hedges on long calls, which will cause the market to go down further, which in turn will cause volatility to spike, which will cause the dealers to sell more calls, which will cause more people to close their puts and calls, which will cause the dealers to sell more. And this cascades, and then reverse ETFs like sell the vol. And this is what happened in NVIDIA during the DeepSeek day. So like that is kind of what drives all this stuff. So if I was going to position my long, short, or whatever, it's like now's a great time to buy a caller. Like we're already up for 4% of the year. That upside call is going to be dirt cheap. That downside put's going to be dirt cheap. And if we get a little pop down, you could even pull off your put for a profit. You know what I'm saying? And I think that's a much better way to go about it, because I'm running straddle every single day, and it's like it always ends up paying. Granted, it basically breaks even, but when you mix that with more convex long calls and long puts that can pay 700 or 800%, and then you mix that with selling short calls and short puts that'll yield every day at like a 1 day duration, like it works pretty well and pretty consistently, because the participation of the options market in it. You don't really know what these catalysts and all those things are going to be.
Yeah. That's a great point. Explain that again to me, because basically taking my viewpoint of you're in my position, you're like, what I would do in this case, until I have reasonable conviction, I would just not short equities until there is a point where I say, okay, now it's time to short via whatever strategy I'm running. But again, my idea is driven by the macro and price. My execution is driven by a technical analysis setup, and the instrument I might use is an equity future. Now, you're in my position. You don't want to pick a direction, but you still want to make money. What would you do in options to do that?
Yeah, I would play the whole like long straddle for a hedge, long puts and calls for protection or upside convexity, and then selling more shorter dated options or strangles against that daily with stop loss. To where that could basically help you out, because your short options will decay fast. They'll win 90% of the time. 99.9% of the time, your stop loss is going to work and you're going to get at your exact price, which will make a smoother P&L curve and Sharpe ratio. And then the 1% of the time they rip up to some extreme, amount, you're going to get market-esque or slightly more than market-esque returns or drawdowns or less, basically, in that case scenario. And then if it follows through for 2 days or whatever, you just resold the really overpriced fall and you're still hanging on to your long straddle. That is like the best straddle you could have bought of the year, and do that. And that's like a much more sustainable way to income. I don't think many people would probably get that when you're trading it. But I think my main point is the options market, don't quote me on this exactly, but I think it's like $600 trillion. Like it's insane. Granted, this is controlling underlying instruments, like the value of the option, actual contracts, I think it's like, 20 trillion or something. But with that, like that is what's going to move everything, because that's how people are hedging. So if there's some type of news event and the market goes down, anyone who bought calls, the dealer on the other side is short calls. So when the market goes down, they're going to basically, they're long calls. The dealer's going to buy back those futures, basically. So now they're continually shorting the market because they bought back their long, which makes the market go down more, which raises volatility, which means more people's calls are worthless, which means the dealers are going to sell back their long calls in the market. This exacerbates the VIX, ETFs, and exchange traded products now need to start hedging and they can't trade, which makes the market go down more. And it basically blows up, which is what happened with this DeepSeek thing like 3 or 4 weeks ago with the whole volatility complex. And like NVIDIA is just the ultimate volatility bomb of the market. And when that thing goes, it's going to go down so bad, because there's never been more ETFs for options and leverage and 3x leverage and people bought calls on an instrument than there is NVIDIA.
Oh. Yeah, I think it was probably a warning shot, that DeepSeek blow up. It's not that I played NVIDIA at all, but I was playing the risk that is associated with it on that day, right? And how that translates into FX. But it was pretty apparent that one shock can almost. Well, I think I hadn't seen S&P futures down 3% in a long time.
Let's see them during that day. It happens quite a bit.
Yeah, I don't know, does it? I mean, we had that yen blow up. I don't know, was the S&P down 3%?
That was August 5th. That was like 4.5%.
Oh.
And then
was it 4.5%?
That was 4.5% off the open. Yeah, Nasdaq was like 5 something.
Yeah. I didn't.
Midday was down 12%, but yeah.
Nikkei was down 12%. Wow, that's. I mean, I was short. Funny enough, not because I'm a genius or I would associate this with mainly luck, but I was short New Zealand yen at the time, so long yen when it happened. So I was fucking delighted, obviously. But it wasn't a very sophisticated play. I would say probably more of an accident. But back on topic, that I just want to echo that point before I move on. I think you just made before this segment, and I really appreciate you saying that strategy and how you approach it, because I think I'm definitely underweighting the importance of options pricing and how it can be used and how options as an instrument can be used, as I said, for smarter kind of risk taking. But your key message earlier on is a little bit different to other people on, take leverage responsibly, use leverage responsibly. Having a 2x in ETF and short fall for diversification, plus you're adding in leverage, may give you higher returns than just a buy and hold strategy, but also gives you diversification. And it means, you're not playing the long NVIDIA game, as you said. I think a lot of people can come to trading playing the wrong game. And that's the only thing that has struck me about what you've said, is that, it's super sensible. But sometimes the people I meet that come in are looking for those options like payoffs. It's like vertical payoff in a week, and they don't think about the diversification element of getting to retirement. As you said, if I could just hit that 25% or 20% a year, I can retire, 5 times earlier or 3 times earlier, whatever the number might be, right? But that was my only thought on that.
Yeah. And the other thing with that is I may talk a little more about investing, but another thing is, you could do this same thing where we talked like putting less money in your 401k, buying 2x ETF and like take that extra 15 grand and like buy some course or go to some event or take some chance in your life to earn more. Cause I also think in the grand scheme of diversity, it's really nice investing in yourself for some type of skill, whether that be even trying a business that you fail at or buying some course that you find of value, because the government can never tax that and never take that knowledge away from you, which is also a very valuable asset as opposed to the weird quoting up and down that you don't really have control over. So I think that's a really valuable asset. Or like if you hit it for 2 years on a bull market with your 2x ETF, maybe you take a year off and be like, I'm going to switch to a career where I can get a remote job so I can move to somewhere that cost of living is less outside of London or something, And that type of flexibility or optionality is what leverage gives you. However, like you can't be looking for that playoff curve with leverage. And like I talked about when we're looking at investments, what's responsible to leverage? So leveraging the S&P is responsible. Leveraging treasuries is responsible. Like they're literally underpinned by the government. You know what I'm saying? It's like you can't really go over too leveraged on them because, they can go down 20% or something, which volatility drag can really get you into some trouble. But for the most part, like it's not a scary instrument. It's like the beta of Tesla is like 2.8. Okay. So 2x leveraged S&P is less volatile than Tesla. And, we're guaranteed to basically get the yield in the S&P. So thinking about it like that and being like, what else can I use this money from to actually improve my life? Like that's what options are. And that's what optionality of money is for.
My last round of questions are just about people approaching the options market from a kind of basic perspective. What are some of the important things people should know about options before they think about getting involved with them?
I'll preface this a little bit from my perspective, but it's like on indexes and widely used liquid ETFs, they aren't as scary as people make them sound out to be, and the function is always size. So I would say like don't be intimidated by them. As long as you stick to ETFs or what those underlying kind of, market ETFs are. And then also with options is like the more you touch them, the more likely you are to not make money, which I know kind of sounds crazy, especially from the short side. So like a lot of free backtesting stuff out there, but there's a lot of strategies where you'd be like, for barely any money, I could get 3 or 4% off of this. And I would just really recommend on like doing those and sticking to them. And the underlying aspect of everything I'm doing, and I like part your C game that no one can progress to until they figure this out, is like you have to develop a thesis, whether that should probably be through backtesting for trading options because it is just all numbers. Then once you believe in that thesis, you decided to make an allocation to it, and then you stick to it and checked back to your thesis of if that has performed correctly. And until you get that concept down, everything I'm talking about and everything I'm doing will be irrelevant to your success. So that is also the cornerstone of all investing. Like I think that sure, go and trade zero-DTE options at a very small size, give it a try, because you're just going to learn that investing relationship quicker, and you're going to realize that you don't know more than the market, and you can't, beat the market without responsibly, like using leverage. You can beat the market because it's essentially a free lunch, and managing your risk on that, you can add to it. But like picking stocks, you have to understand that the more volatile something is, or the longer in duration it takes to realize if you're smart or if you're just taking way too much risk, the harder it is to tell whether you're lucky or good. And some people can just make money because they had a good timing for that. And don't quote me on this exact example, but it's like between 1950 and 1970, the Dow returned like 30% or something. And between like 1978 and 1990, after inflation, it returned like minus 10%. So if you would have been the young guy that took a lot of risk in the first half of that, you could have made no money the second half and you would have been filthy rich. Whereas if you flip that around, you made no money. I think it's Taleb's quote where it's like, how do you drown in a river that's 2 feet deep? The average depth is 2 feet,
Yeah. Wow. Very good. Yeah, I blanked there. I think I was just admiring that knowledge, to be honest. I appreciate that answer. You mentioned earlier your ability to backtest was really strong, and you had something like 90% of your expected returns were in line with your returns were in line with what you were expecting.
Yeah.
When you're designing backtests or when you're running backtests, how do you make them robust?
Yeah. So what people get wrong with backtesting is backtesting is not like messing with your software and then you're like, oh, I got this, and you run it. Like the iteration of actually backtesting is you figured something out, you think it works, and then you run it for like 6 months and you kind of see where it's behaving and not behaving, and you tune it a little bit executionally until you think it really matches. And then after 90 days, 180 days, you realize, okay, in aggregate, I messed with this. Yeah, I worked on it for 3 months. I ran it for 3 months. I tweaked it again. And now for 6 months, it's matched. Then you've done your back test, and that's like a year case. And this could be as simple as selling a put like twice between 1 and 3 p.m. You know what I'm saying? So that route is like anything else. People want quick, but the reason it's so consistent and it pays so well is because you have to earn that iteration and ability to basically go through and do it. And if you're constantly changing, again, you don't have that initial standpoint to have enough confidence to ever follow through with anything because your base is gone, and that will always hold you back.
So I mean, come at it with an idea, minimal tweaking just for execution, and then stick to the plan and implementation. That sort of...
Yeah. And you have to check, does your back test match your forward test, you know?
Yeah.
And it like, you may have to flip around some slippage or commissions, or maybe your data isn't good to figure it out. But once it does, now you're in the path that it's like, okay, how far back does this become profitable? Like, if I'm matching the back test and it's not making money, what's the problem? Or what's a counteracting position to do that? And like, what I must start with all my back test is what's a long that I can lose a marginal amount of money on, or hopefully break even, or even better, make money on. You know what I'm saying? And it's like, right now, long calls make money, but if the market goes down, that's not going to work. You know what I'm saying? So that's almost always what I start. And then once I find that long ball that can break even, I'm like, okay, how can I benefit from this by selling Condor? When my Condor loses, what could benefit from that? You know, is it some trend following? Is it some long put or long call? And now we're kind of in a different, realm, and it's ultimately portfolio. That's where all the edge is, because it's going to smooth out the majority of that noise. But if you don't have good inputs, you're never going to be able to build that portfolio. So it's like taking that step by step and iteration and getting to that point where you've made that portfolio that just goes now.
Yeah. Yeah. So I mean, it's like adding strategies and anticipating it going wrong, and what would make money if it went wrong, and then what would make money if that went wrong. And then is that kind of how you...
Yeah. And the other thing too is like, you have to just mash the probability button. So there was some famous study with like rats and humans. I think it's called like the Iowa behavioural psychological study or whatever. Basically, that rats and humans, there was like a coin or a deck of cards. And when you flipped one of the two decks, like 60% of the time when you flipped the one deck, you got like a carrot, and the other one you got shocked. And after like 20 tries, they realized that humans figured out the pattern, but humans are made to recognize more patterns. So they wouldn't believe in it. They'd think there'd be a reversion of the mean. And they kept on guessing for like another 50 tries until they finally just matched the probability button at like try 80. And then the rats, basically after 20 tries, they could see got it in their brain. And then all they did was just mash the probability button constantly. And this kind of shows how you can piss away edge from thinking you're smarter doing whatever. And kind of what I'm saying is like, you can make a bunch of money, just not being an idiot. Like there's 4 types of edge. There's analytical edge, which is your ability to analyze data. Newsflash, we have absolutely none of that. Even me at the hedge fund level, none. We have none. All of it is the market makers and have all the data that are like instant feeds. Then there's executional edge, which is being able to outlay that strategy. Also, we have no edge, none, absolutely none. The only edge we have is realizing that we have none. And all the market makers with, direct fiber to the exchange have the advantage. Then there's informational edge, which is like they're getting insider information. They know what the report is going to come up before time. Again, we have none. Then there's behavioral edge, which is basically people are going to be greedy. People are going to be fearful. Trend works because more people are buying the S&P than ever before and keeps on going. And you just realize you're the counterparty to that. And there's so much money to be made just in that facet. And I know I'm dumbing it down to a certain degree because there's a bunch of details and not pissing away the edge you have in those other 3 components to get to that. But it's like, that's the core, is your behavioral edge. And I'm from the standpoint that all I know is options are more accurately priced than the underlying. They don't even need to be accurately priced. That's just the only standpoint I'm taking. And I've done everything to basically limit drawdowns by buying options I know are overpriced to protect against that, and limit drawdowns where that risk reward works out. And then just mashing the probability button as much as humanly possible.
Nice. And as a last point, Mark, can you let people know where they can find you online?
Yeah, I mean, if you type in Mark zero-DTE, I'm sure I pop up everywhere on like Tasty Trade and LinkedIn. or if you go to my YouTube channel, Zero Day Mark, it's like you can find me on there. So yeah, I mean, most information's on my videos. If you comment on the stuff, I'll comment back to it. I'll usually take calls with people as long as you're actually thoughtful and like have something to say rather than just, oh, do you do coaching on zero-DTE or whatever? But yeah, I mean, it's attainable. You can reach out to me. It's pretty easy to find me online and everything.
Hey, you must be one of the global authorities now on zero-DTE.
Yeah, it's a small market. I don't think it's a very big deal. They're like, it's weird, or like it's really big in India, and the government just changed regulations, so like a bunch of Indian people are getting into the space. But yeah, like I guess mainly I'm doing a content marketing strategy for my business, so I'm putting the stuff out. I'm about to do like a big 90-day sprint here, but then I think I'll almost be at a size where I can lift off the content and go a little more black box-ish. But yeah, I thought the business of a hedge fund would be a lot more trading, but the vast majority of my day is just spent on like marketing and like reading and making content. Really? Like, yeah, that's basically the entire day. It's like, even before we talked, it's like I was writing up some thing I'm going to make for a video. I got like 2 more calls today, one with my video editor. And I mean, I did so much work on trading and backtesting up front that, you know, I'm basically good. I'm just checking it. But yeah, actually trading, I don't spend much time on it. The other thing I didn't realize about hedge fund things, like the hours are actually really chill. Like we don't work that many hours. It's like you're only working when the market's open. You can only make money when the market's open. However, like the focus and mental strain of those hours is pretty intense. So like I may only work, like obviously I've worked 60 or 70 hours a week or 7 days a week, but it's like predominantly I work around 35 hours a week, but I'm pretty dead from that. And I'm also very religious about like protecting my time around that I'm not doing things that will like mess up with my sleep or eating the wrong things or like not taking care of my body so I can show up at the highest mental acuity. Whereas like when I worked in construction, it was just like drink energy drinks and don't sleep. And like you weren't really doing complex work. So you just grinded away at the hours like it was no one's business. And it's like, that doesn't really work in the fund space. But yeah, comparative to private equity or like investment banking, the hours are chill in hedge funds.
Nice. And I mean, you're fully systematic. So I guess that part of it is kind of executing away.
Yeah, it's a joke. Like I like tell people like this year I've actually only made 1 trade, which was on August 5th. I had to manually, because I had some financed long ball hedge overnight. I had to manually take out the order because it was obviously past my stop, in the AM. And that was the 1 trade I've made in 18 months of hedge fund. And I think I've made, 300,000 trades or something. Wow. So yeah, it's pretty like just set it and forget it. I look at backtesting and stuff every day and I like check the numbers. But yeah, in terms of operationally, it's basically nothing.
Awesome. And are you a one-man kind of show in terms of the hedge fund?
I work with some other like quants / hedge fund managers. That's a guy in the UK that runs over 100 million, and another guy I know in the US that runs like 50 plus million in zero-DTE. I'm obviously the smallest. So like the 3 of us and 3 quants are kind of in a private Discord where we talk to each other. But yeah, apart from that, like I'm the only trader. And then I have like contracted out legal, accounting, video editor, speech coach, script writer, LinkedIn, stuff like that. Yeah. But I mean, there's not much, it doesn't take much work to, change the contract size from 12 to 14,
Awesome. Well, you're breaking a stereotype there.
Yeah, I worked a lot in the past, but once you get that, and also it's like, I don't have a veil of like, I need to look busy at work, So I also like work from my house. So yeah, it's chill. But yeah, even in real life, I don't think hedge fund guys work that much.
The dinners and taking class.
Yeah. I mean, if you're a long short equity guy, I could see during earnings, you'd be working like 6 days a week, 80 hours to like keep up with reports and stuff. But outside of earnings season, if you're long short equity, like what are you doing other than looking busy to try to get a promotion that actually takes 50 hours a week, If like your positions are moving slow,
Thank you so much for your time. I really love your mindset, energy, and just the way you do things, I think is a real professional's approach. And I think anyone watching trading, whether you're trading options or not, just do that more, be more of a professional, because I think, as you said, and the behavioral edge point, if you can be more of a professional and not take the stupid losses or make it a little bit more of a science and less of a gamble, it will really stand well to your P&L. But thank you again, Mark. I really appreciate your time.